the last session of today. So we have two papers, one by Rob Engle and one by Solomon Hsiang. Sol is going to talk first and talk about the impact of climate change on the global workforce with his team. There you go.
Oh, great. Thank you. Pleasure to be here. Thanks for having me. What I'm going to share with you right now is some joint work with the Climate Impact Lab, which, as you can see by the lack of white space on this page, is a fairly big team of climate scientists, economists, data scientists, and engineers. And we're trying to understand sort of the global real-world impact of climate change using evidence and data. So just to set the stage, I know we're all sort of familiar here. We've all been talking a lot about damage functions. The talks that I've seen so far haven't shown any. The interagency working group used these damage functions to describe the economic impact of climate change from changes in global mean temperature. These are the three models that get discussed a lot: the Dice, Fund, and Page model. On the horizontal axis is the change in temperature, and on the vertical axis is a change in global value, measuring welfare changes. And one issue is that the data that goes into these damage functions is largely untraceable, or in many cases outdated. So, for example, at one point we did a deep dive into the origin of these damage functions. And what you see here is a sort of a bar chart describing the time of publication for all the empirical studies that were used to construct those damage functions. And so one point we make is that most of these studies were calibrated before, the early 2000s. And we have actually learned a great deal since on how to implement empirical studies and how to use econometrics. And so since then, there's been a lot of research. This is not done by the Climate Impact Lab. This is just a literature review of emerging research using new technical tools that we think would pass modern standards for econometric identification. And so our view on how to proceed, I think, is perhaps diametrically opposed to Bob's view. Instead of going backwards in time, we're going to go forwards, and we're going to say we believe that the best available evidence should be applied to assembling the damage functions, and we want to use data to reflect real-world damages around the world. And so what we're going to try to do is get as much representative data as possible. We're going to amass that data, and we're going to try to understand global patterns of adaptation. We're also going to try to understand the cost of those adaptations when we're thinking through changes in economic changes in climate, resulting from the climate. And the team is working on a variety of different sectors in parallel. So we're trying to provide insight into human health, the energy sector, labor supply, agriculture, coastal damages. And so all these projects are going on in parallel. They all have a similar flavor to what I'm going to show you today. Today, I'm just going to focus on our labor sector, so you have a sense of what's going on, because it's too much to try and cover them all. So just to sort of set the stage, this is one of my favorite studies from the 1940s, where Charles Mackworth took some folks from the Navy and he put them in a room, turned up the temperature, and made them do arm curls until they collapsed and could not do any more arm curls. Okay, and so this was an experiment on whether or not providing these individuals with information and additional incentives to do more arm curls actually affected the impact of temperature on their ability to perform. And so what you see on the right-hand side is a graph of the number of arm curls that they were able to do before collapsing as a function of the temperature in the room, which was experimentally manipulated. And so what you see is a decline, and I think the point of the study was that, with and without incentives, they essentially did not change the physiological constraint imposed by thermal conditions on these individuals. So the shape of this curve is something we're going to look for in the data. What we're going to do here in this study is not focus so much on productivity, but we're going to try to understand disutility of working outside when it's extremely hot. Many people like different temperatures, but overall there exists some sort of limit after which people become extremely uncomfortable. And so, many workers today in the modern economy are subject to very extreme temperatures. So you can see, stadium construction workers in Qatar or farmers in India are experiencing very high temperatures on a regular basis while doing their jobs. And so one way to think about this paper is we're going to try to understand what is the overall immiseration of the future workforce that's going to occur as a result of warming under a variety of different scenarios. And we're going to try and put some numbers to that. Now, the way we're going to do that So we're going to try to think through the worker's decision about how they supply labor, and then what changes in labor supply actually tell us about how much less happy they are to do their jobs. So in sort of the simplest framework, what's in the paper is actually a little bit more complicated with more sectors, but I think this does the job. You can just think about an equilibrium where workers choose their labor supply, where they're getting paid a wage, and while they're working, they suffer some disamenity from doing the actual work. That is a function of the amount of labor that they're supplying, and also a function of the temperature. At the same time, firms are going to offer wages where, given the fact that labor is an input into production, and we're going to look for some sort of equilibrium where and try to understand how changes in temperature affect these decisions. What we're going to see, and I think a key point, is that changes in labor supply are communicating information to us, not just about what is happening in those few minutes of skipped work, but actually about what the worker is experiencing throughout the entire day, inframarginally. Okay. So to see this graphically, here's our labor supply and labor demand curves. So what we're going to see is workers, here we imagine that there's some optimum temperature, say like something very comfortable, where we find a wage that is observed and a labor supply that is achieved. Now, as we saw in Mackworth's experiment, we could increase the temperature, reduce the productivity of those workers, which means their marginal product will be lower for any amount of labor that they supply. And that's something that has been studied in previous literature. We also are pointing out here that as the temperature goes up, workers are going to be unhappy during every minute of the day that they're supplying labor. And so that is going to essentially increase the wage that they would need to be compensated in order to provide the same amount of work. So as you shift from some temperature that's like the ideal optimum temperature to, let's say here on this graph, it's T1, we have two shifts in supply and demand for labor, and we're going to try and think through what that represents. I think the key insight here is what, as we're pointing out, we're going to observe a small change in labor supply, but that communicates information about what is happening throughout the day as the workers are working. When you think about overall changes in welfare, one point we make is that actually, there's been talk about reallocation changes in wages, but essentially changes in wages due to these temperature changes are just a transfer between workers and the firms. And so in total welfare terms, they cancel out. Now we can think about what the other regions on this graph are. So in prior work, we tried to think about the value of all these lost minutes work, just in terms of their overall output, thinking through what the marginal product is. So that's been enumerated in prior work. It's not enormous, but it's also not nothing. In other work, folks have looked at the overall changes in productivity associated with changes in the temperature. And so you can think of that as changes in the marginal product at all moments throughout the day, right? Maybe workers are working more slowly, like in the mornings and in the afternoons, and then they quit early, and you can think of adding that all up. And that would show up in like a top-down model of looking at the effects of, say, temperature on GDP, for example. What we're going to do in this study is look at a totally different object that has not been calculated in any of this prior work. And we're going to try to calculate the area of this this region, this four-sided region. I don't know the right word for it, quadrilateral. And what this is the disamenity, the immiseration of individuals throughout the day. There is one important structural parameter we will invoke, and we can test sensitivity to it, and it's the elasticity of labor supply. And that's going to tell us about how much changes in supply on the margin are going to indicate welfare losses inframarginally. So how are we going to do this empirically? We're going to collect essentially all the data we can around the world on time use. And so we've literally scoured the Association for Time Use Research databases. We've attended their conferences actually, and tried to find everything that's available. So it's not everywhere in the world that we would like, but what we have here is a graph from some regions that we think are broadly representative of many parts of the world, although there are regions that are difficult to match, like Africa. We have temporal coverage in the most primarily in the early 2000s, and we are representative, at least directly representative, of roughly 3 billion people. But we will also think about using income and climate as a proxy to understand what responses elsewhere might look like. Just to give you a sense of what this data looks like, it's extremely rich time use data where you get a lot of detail and information about what people are doing, in some cases every few minutes. We look through this data and we try to harmonize it as much as possible. It is often That turned out to be an enormous task where you're harmonizing these types of surveys across very different collection agencies. And in general, we're going to look at how the overall area of work is changing as individuals are exposed to different temperatures. Now, we're following the Graf Ziven and Nidell paper in spirit in many ways. One of those ways is the way in which we categorize workers. So we're going to think of, GZN sort of pointed out that some workers are much more exposed to temperatures. Those they call the high risk group. And so those are workers in agriculture, mining, construction, manufacturing, where their work environment is tightly coupled to outdoor conditions. Then there's also the low risk group. Those are probably most of the people on this call, individuals who have the ability to work in a controlled environment and are only loosely exposed to outdoor conditions. And so throughout, I'm going to talk about the high risk and the low risk group. The high risk group is basically just more exposed outdoors. We're going to link these time use surveys to a lot of different forms of data in the analysis. I won't go through all of them here, but we're using a variety of different historical climate projections, census data. In some cases, we're using satellite data to try and infer income where it's not available at the locations where we are collecting data. And then in the future analysis, we're going to be using standard projections. I'll show you some of those. So what we do is we've basically assembled a very large quasi-panel-like data set for individuals around the world, and we're stratified based on whether they're in a high-risk group or in a low-risk group, and we're going to try to predict the number of minutes they work as a function of a variety of controls and covariates at the individual level that we observe. In particular, what I'm going to show you are the shape of basically the marginal change as a function of daily temperature, which is going to be modeled here as a restricted cubic spline. We can get into that in the discussion if that's of interest. We're also going to think about precipitation as something that might influence labor supply. And we're going to have things like day of week fixed effects, region fixed effects, kind of all the standard bells and whistles of modern empirical work.
But Solomon, can I ask you a question? The
Sure.
The left-hand side variable, what's the definition of labor time? Does that like housework, for example, is that in there, or
this is formal labor. We're only studying formal labor here. That's a great question. So here's the main description of that function f that's describing the minutes worked relative to an omitted category. So you can think of the omitted category here is occurring at around, I think it's 25 degrees Celsius. And so changes in the minutes worked as it gets hotter, individuals who are exposed to outdoor temperatures work many fewer minutes. Okay. One reason we use a restricted cubic spline is it constrains the slope as you move towards the edges of the support. So it becomes a linear function. So we observe a phenomenon. This is actually very similar to the Graf Ziven Nidell type results in many ways. And the low risk workers are individuals who are not exposed to outdoor temperatures, and they have a very modest and small association between the minutes worked and the outdoor temperatures. You see down here, our samples are quite large in terms of the number of individuals, although this is extremely messy data and it's challenging to work with. So we have sizable confidence intervals that we will try to account for in future calculations about what these imply about the SCC.
But Solomon, just understand, is that the variation on the variation here in temperature, is that cross-sectional? Is all cross-sectional, or is this within person over time?
So most of these, that's a great question. So what it is it's a within administrative unit repeated observation. So in general, these surveys are so data intensive, they're so onerous for individuals to record what they're doing every minute, that they're not generally recorded for an individual multiple days. So what we do is we have fixed effects for like the county that individuals are observed in, and we condition on, for example, their sector of employment. And so we're looking at, say, individuals in Frankfurt on given days sequentially, but it's not the same individual. So it's sort of somewhere between a panel and a cross-section. So now how do we link this to empirical projections? I think this visualization is particularly important. So what we do is we actually have, at the lab, we've assembled sort of this battery of climate models that are at a high resolution, but also reflect the distribution of global climate sensitivities. And so that's an important thing. If you look at regular GCM models and you just look at their averages, for example, there's a lot of contraction towards the mean, and you don't really sample the edges of that climate sensitivity distribution. And so what we've done is we've basically gone through a bunch of technical details that are actually previously published in creating sort of surrogate models that represent the tails of the distribution and can be used, and then we can use all those models in a projection. What we're showing here is across those different, the distribution of temperatures that have been observed historically for our population in the sample. And then you can ask, well, how is that going to change going forward? So here's RCP 8.5. This is the change across all these different models that are now capturing the full distribution of outcomes in terms of what we would expect individuals in this sample, if their location stayed the same, to experience going forward. And so you see a dramatic increase in the number of days above 30 degrees C, and those come at the expense of a reduction in the days below 30 degrees C. Now this matters, as you can see on the left, because if you have a large mass of days shifting to the right, and you superimpose it on this type of response, what you're going to expect is that workers will be suffering more as they move down the far side, the right-hand side of this curve that I showed you earlier. So in trying to calculate and sort of enumerate what those impacts are for all the individuals around the world, what we're going to do is we're going to take an approach sort of similar to previous approaches, but we're going to look at a much finer spatial scale than I think people have seen in the past. So on the left is the DICE model, and we point out that it is a one region model. And so it's essentially treating these locations homogeneously. In '96, the FUN model was published, and a key innovation was that it broke the world up into 16 different regions. And so it treats, for example, the United States as a single region. What we have done is we asked ourselves the question, well, we're now, in the 2020s, and we have cloud computing, which we are using all the time. If we were to redesign integrated assessment today, how would we do it? And so the answer that we came up with is the design of basically 25,000 regions. These regions are assembled using subnational, generally admin 2 political units, so think counties. But because computing power makes it challenging to work with all counties in the world, what we've done is we've taken the existing set of counties and we've optimally merged them together in ways that maintain income and climate homogeneity within each unit of observation. And we've also tried to do this in such a way that the population of each impact region, which is what we call these units, is roughly the same. And so this gives us a set of locations for which we can account for these impacts that we think could be comparable populations within them are relatively homogeneous and they're comparable size across locations. We also maintain political boundaries because we find that that's very useful in communicating our results or mapping them onto other types of systems, which is why we didn't use, for example, a gridded system. So what we can do is we can make projections. And so what I'm showing you here are projected impacts using the response curves I showed you earlier on the high and low risk workers in 2100 under RCP 8.5. So this is the estimate for what you would calculate for the minutes of work that are lost at the end of the day because workers are essentially quitting early. And these are in units of minutes. What you can see are many different types of patterns. I think it's sort of a rich graph, but it's very similar to things people might have seen elsewhere, where hotter locations around the world are suffering really large impacts, mainly because they have a large mass of days already fairly far to the right, and low risk workers. Yeah.
Can I ask a clarification question? So you're looking at minutes lost per day. Are you in one way or another correcting for the fact that as temperature goes up, the quality of their work, they become less vigilant, they become not so good at their job? So how is that picked up in your estimates?
So like I mentioned before, that's actually not something we're trying to capture here. That's something on the productivity. You could think of if the quality of work declines, that would be the change in the productivity. And so that's actually something we've left to other work. So it's a good question. There's lots of potential impacts. Yes, Robert.
Could I also ask along the same lines? Are we seeing migration, or are we seeing people working fewer hours but staying in the same location? Or can you tell them apart?
So what we're doing here is we're using some existing projections, the standard projections about population, and we are allocating individuals based on the current spatial distribution of the population. In another sector, I know I showed you a whole bunch of sectors that we're looking at, we're trying to understand how migration responds to changes. And so it's very reasonable to imagine that migration will change the distribution of workers, but right now we're holding population distributions fixed in space. So one thing you see here is that I think quite clearly people who work out, sorry, is there one more question? So what you see on the left is that, you know, the high-risk workers, individuals that are working in exposed environments, are much more heavily impacted than low-risk workers. We think that makes sense, but it also means that thinking through what fraction of the population is in each bucket going forward is an extremely important exercise. So what we're going to do is we're going to try to think about how workforce composition is going to change in the future. This is potentially one of the most important margins of adaptation, as structural change moves more workers from outdoor environments to indoor environments. Now, we had a variety of different theories that we could write down about what might govern the distribution of workers across these two shares. And it turns out, I'll show you in a sec, actually, empirically, we thought that maybe as populations are exposed to outdoor temperatures very heavily, there's a big incentive to move indoors. It turns out in the data that climate has almost no predictive power over what fraction of the population is actually working indoors, and that it's almost entirely driven by structural change. I'll show you that result in a moment. And then once we try to estimate those relationships, we're going to use those relationships in projections going forward to try and reallocate workers. So Robert was saying, do they move across space? No, but what we are going to do is we're going to move workers inside over time as the century unfolds according to different rates of growth. The very simple empirical exercise, and there's some nice theory to back this up, but I don't have time to share with you now, is we're going to try to predict the share of workers in each location that are in the high-risk group versus the low-risk group as a function of income in that location, as well as a polynomial in temperature, and a country-specific fixed effect, for example. And so we can imagine, like, as incomes in a location, so countries will have a continent-specific fixed effect because different regions will have sort of different patterns of work. And I'll just show you the results because they're quite striking. What I've done here is we can cut the data two different ways. So basically what I'm showing you is we stratify by the temperature group. That's the color of these lines, and then plot the conditional expectation function. And so what you see is that the high risk share declines as regions become wealthier. We observe this just in the global cross-section, but the overall relationship with income is itself not affected by the long-run temperature of those locations at all. If you cut the data the other way, you can ask, okay, how does the high-risk share change as a function of temperature among the different income groups? And again, we see that it's incredibly flat function. So basically, the point here is that income matters a tremendous amount for how many people are working outside versus inside. Climate does not seem to matter too much. That said, we will still account for this very gradual slope when we make projections going forward. This very simple model actually does.
Can I just double check one thing about that regression? That's still
Sure.
on the basis of those thousands of localities. That the unit of observation is still, the sample size is at 25,000. What it was, it's not a country level thing.
No, it's not country level. It's subnational units. That's correct. Yeah. But what we've done is we've aggregated individual level data to subnational units so we can get shares. So this is no longer at the individual level.
There's one more question from Matt Kahn. Matt, can you unmute yourself, or shall I ask the question for you? His question is, urbanization has a causal impact on lowering the high risk share. Could you comment on that?
So I would argue that most of the effect of urbanization is going to be captured in these rising incomes by proxy. We are not going to model urbanization explicitly in this particular analysis, but what we are showing are the effects within each administrative unit over time. So the future work could definitely account for that. So what I'm showing here is just what that very simple model predicts in terms of the modern actual share that's high risk versus what is predicted. And it has quite good performance just in the simple cross section. And these are for the locations where we can get this data, which is actually at a larger scale than what we can get individual level supply, labor supply data at. Then what we're going to do is we're going to try to fill in the regions of the world where we're missing data given income and climate in those different locations. And then we're going to allow the fraction of workers working outside to evolve into the future based on how we expect climate and incomes to evolve. And so what you see here is the share of high-risk workers that we estimate today. So darker colors actually indicate a lower share. And as we move forward down to the century, fewer and fewer workers we would expect to be working outside, primarily, as I showed you, as a response to structural change and economic development occurring around the world. So what's going to happen is we're going to take workers and we're going to be moving them from this group on the left into this group on the right at the same time as we're trying to account for the impact on labor supply that is happening within each group. So when we do that and then we aggregate between those two groups to think about what a average or randomly selected worker might be the type of behavior they might exhibit in these scenarios, you're basically going to be taking the weighted sum of those responses. And so here I'm showing the average response on a fairly hot day, so like a 37-degree day. Today around the world, we would expect there to be a heterogeneous response based on the distribution of workers. And as we move forward and structural change occurs, we're going to expect the impact of future warming to lessen as we progress through the century. Finally, what we can do is we can add up all those effects, sort of take the inner product of the distributions and changes in the climate, and ask what is the overall impact on a randomly selected worker in terms of the predicted minutes of work supplied. And here's what we're showing you just for RCP 8.5. This is not yet doing the valuation though. This is just asking what are the observable changes we would expect to occur in the minutes of labor supplied. Here you can see as we go through the century, there's the projection of what would have happened if you held the workforce composition fixed. So if you didn't allow workers to move indoors with structural change, as you might have guessed, if we allow workers to move indoors, there's a smaller impact. Okay, so accounting for worker composition reduces the impact by roughly a third. What's now important is to think about how much what this is telling us about the immiseration of workers throughout the workday. So what is the disutility of working in extremely hot environments around the world? If people are quitting early, that suggests they're suffering throughout the day. And so what you see here are calculations that are monetizing these impacts for workers in two different scenarios, the 8.5 and the 4.5 scenario. As you see, there is actually a big benefit from mitigation here. If you move into into a 4.5 trajectory, you have a large reduction in overall immiseration of workers by end of century.
Sorry, Solomon, can you remind me what RCP is?
Sorry, so RCP, so this is called the Representative Concentration Pathway, 8.5. These are standardized scenarios that are used by climate modeling teams around the world, so that the climate modeling teams basically say, give me an emissions trajectory that's the same for every team, so that they can compare across their models, like what is the same or different about their model outputs. So there's a few different standardized trajectories, one of which is 8.5, which just means there's 8.5 watts per meter squared of additional radiative forcing at end of century. I know that's a very intuitive metric. And 4.5 is a scenario in which there's a little less than, there's roughly half that. Right now, I think the consensus is that we are somewhere in between these two scenarios in terms of what our actual trajectory is. Sometimes people have called 8.5 business as usual. I think it looked more like business as usual a bit in the past. But in other cases, it's been discussed as an extreme situation. I think the jury is still sort of debating how we should interpret these. But we will show you actually how to compute the social cost of carbon in sort of an arbitrary case using these numbers. So these are numbers that describe a trajectory going out to 2100. And what we do is, in order to compute a social cost of carbon, we actually need to compute marginal impacts of emissions. So not just these very different scenarios, we need to think about how marginal adjustments would change welfare around the world. So what I've done for you here is I take the global aggregate damages in 2100 and I plot them against the global mean temperature that is observed or realized in that particular model. Okay, and so each data point is a realization of the entire world in which we're trying to add up all the immiseration that's occurring among workers, and we're plotting those as a scatter across these two scenarios. Now, this is importantly fixed at a moment in time in 2100 because this curve changes. But what you can do is if you fit a curve, you get something that is essentially a damage function in a particular year in a particular sector. Now, what's important is we also, because a large amount of damage is expected to occur after 2100, we've developed a procedure for taking these damages and extrapolating them past 2100. The reason we do that is because do not exist high-resolution climate model scenarios beyond 2100. And so there's a little bit of a disconnect between what the climate models can tell us and what we would like to have in hand for economic decision-making. So we can construct damage functions that are evolving over time for the labor sector, but we also need climate models. So here's a little display of what the problem is. We have high resolution climate models that go to the end of the century. So for two different scenarios, you can see changes in temperature that occur by the end of the century, but we don't have information for what happens after 2100. Now, this is certainly reaching very far ahead in time, but prior estimates suggest roughly a third of damages occur during this period. And so it's important to at least think through systematically how we might consider them. So what we do is we've developed an augmented low dimensional climate model. It's called the FAIR model. We didn't develop the original one, but we've done a lot of work on it since, which effectively is a low dimensional emulator for global mean surface temperature. And so it accurately recreates what occurs in the 21st century, but it allows us to continue projections beyond that. And so this is a bit more sophisticated and probabilistic than what is happening, for example, in the DICE model's climate module. Finally, what we're going to do is we're going to combine those elements. We're going to take that evolving damage function and we're going to take this low dimensional climate model to think about how a marginal emission today will cause damages throughout the next several centuries in terms of the immiseration of workers. And so just to think through what that calculation looks like, here's a graph over time. And what we're going to do is we're going to impose an impulse of CO2 emissions. We're basically going to emit a gigaton of carbon today. And so that's just a spike here. Then we're going to propagate that through the system. And so what we see is it leads to a rapid increase in CO2 immediately. Then some of that CO2 is absorbed by the ocean. And then the ocean and atmosphere equilibrate over the subsequent century. This in turn leads to a large temperature anomaly initially, and then feedbacks cause that temperature effect to decline to a long run change. But there is a large amount of thermal response globally that is actually felt immediately within the next decade. And then what we do is we feed that through our damage function to think about damages on the future, and those get discounted then to the present. And so our goal here is to match this impulse to the integral of this curve, which is the overall long run impact on these workers. So when we do that calculation, we end up with these types of numbers. Now here, what we're doing we're imposing just a range of different fixed discount rates. We are not declaring our religion here, but we actually allow other people to take their religion and find themselves on this graph. These are preliminary estimates, so we're still just putting the final touches on these numbers, and we are introducing some other types of discounting to deal with other types of scenarios folks have suggested. I think the numbers in general, like, if you look around the 2% range on the left-hand side here, I think that's a reasonable thing to do. You get estimates that are around $5 to $10 per ton of carbon. In terms of just the disamenity it will impose on the global workforce in terms of forcing them to work in more extreme thermal conditions. Now, this is only one component. This is a partial social cost. And so what is important is you think about other sectors of the economy and you add them up, and that will allow you to have a more comprehensive picture of impacts. This, we think, is a practical approach, and we are implementing similar calculations for many different sectors. So just to wrap up in the last minute, none of the existing climate models capture the disutility of workers around the world. And we point out that that can be estimated empirically by observing how workers supply labor on the margin, even though it's a cost that is borne inframarginally. We use data covering roughly a third of the world's population to estimate this relationship. We don't see very clear evidence of individuals adapting to the climate itself, but we do see that changing income has a big effect on how many workers will be exposed. We then do a high resolution projection to think through what these damages look like around the world, and we compute a partial SEC for labor disutility that's around $5 to $10. And so importantly, this number, it does not exist in any prior integrated assessment. So it's literally an omitted category in prior work. And so from work by Delaveine Diaz, for example, it's $0 essentially. And so we believe that this general procedure for how to tackle different sectors and elements of the social cost of carbon is both sort of represents the best available scientific approaches as well as economics, and can be used to inform policy in a very structured and disciplined way. We have more information on the Impact Lab website in case anyone's interested, and I'm happy to spend a few minutes chatting about questions. Thanks.
The floor is open for questions now. So if any, yeah, very, very good. This is on behalf of everybody. If there are no questions, I will start off the questions. Can you say something about how you do these things for disutility of labor supply, for conflict, maybe for agricultural damages? And then would you just add them all up? Don't you think there's some interactions or some, what's your vision on that for the longer term? Because you obviously have the whole lab with maybe 9 or 10 of these sub-projects.
So yeah, it's a great question, Rick. There is, as many people know, kind of two ways to think through assembling damage functions, empirically at least. One is to take a top-down approach where you look at something like GDP or some macroeconomic representation of the economy, and then try to estimate costs, and we've done some work there. An alternative is the bottom-up approach, where you try to sort of enumerate the impact on different sectors and sort of add them up in a structured way. That has some benefits, which are that it allows you to see where costs are coming from. And for example, we think that's important for policy because it allows people to think through adaptation impacts. It also allows you to account for impacts that are not captured by the market very well, or not clearly represented in sort of GDP type numbers. So we've taken both approaches. The Impact Lab is very focused on the bottom-up approach, in part because we think it's very important scientifically to do these types of studies, but it is quite difficult to do, as you can see. So we're implementing it for many different sectors. For example, we have released public work on mortality impacts around the world. And so one thing you can think of is whether, and so to come back to Rick's question about whether you can just add these all up, we've done a little bit of theory work on how one might try to add them up in a sort of systematic way, avoiding double counting, which is very important. Now, in some cases, you could imagine they might interact. So for example, we are modeling migration. And so we will eventually be taking results from migration and imposing it on these other sectors. At the moment, we aren't doing that just yet. But in general, a lot of these effects are not dramatic. There are first order impacts that matter, but you can imagine you have basically a delta in one sector and a delta in another sector. And so their sort of product, the way in which they interact, tends to often be a much smaller number. So we are focusing our attention right now on sort of the first order effect within each sector, adding them up, and then eventually allowing them to interact. The one important way in which they do interact, though, is they interact in terms of how you calculate welfare impacts. Because if you suffer a lot in one sector, that actually substantively affects the marginal utility of consumption, even in other sectors. And so we are being very careful in how we add them up and account for risk as well, because they can have interacting variances that matter. That was a very long answer. I'm sorry.
Thank you very much.
Making time for people to think of other questions.
I've got 3 questions. So I've have Glenn Rudebush. Did I see your hand as well, Lind? And then I've got Francesco Caselli, and I've got Thomas Hickler. And did I also see Alex? So we go in that, maybe you collect some questions and then you can try to have a go on all of them at once. So Glenn, do you want to go first?
Sure, I'd be happy to. How does the shape of your partial damage function compare to the dice inverse quadratic? I think you had a picture of that, but I'm curious about how it generalizes. You know, this is probably related to your other work, but does adaptation kick in? Is it going off to infinity? as in the dice
It's
model?
totally quadratic. It just looks really at a global level. It's very quadratic.
At a global level.
At a global
Okay.
level. If you add it all up globally, but if you look at an individual location, it could have a very different type of shape. But
Right.
in many sectors, it just seems like that's a very good approximation of the data.
And one
Francesco?
other.
Oh, sorry.
Oh, sorry. Go ahead.
Francesco? You have to unmute.
Yeah, sorry. So okay. I had I was trying to think about overestimates and underestimates while you were speaking. So one thing I already asked you about, which is homework, informal labor markets, self-employed farmers. I mean, it seems to me that it's actually at least possible to conjecture that, say, informal workers will be subject to even more disutility from working in high heat than formal workers, even if they're both working outside, for example, or people who are working on a farm, or people who are doing work at home. So that's one slight concern. That's a concern with underestimate, I guess. And the other, perhaps more interesting point about underestimate is what happens when you come close, which I think you must for many of these people, to the subsistence margin, where they are very close to a subsistence level of consumption, where literally the option of cutting on labor is not there, because otherwise you won't be able to feed your children. And so, it may be that these people are experiencing a heightened discomfort for working in the heat, but they can't signal to you this discomfort by cutting on labor, because they still need to earn the money to meet these subsistence levels.
Okay,
So
thank you.
That's
Thank you,
Francesco. Can I just
add
one thing on the other side, though, which is the leisure margin? Because why do we only focus on the utility from labor? I mean, conceivably there is an increased utility from leisure when temperature goes up. It's nicer to be, the pleasantness to be on the beach may be strictly increasing in the temperature at the beach, and so maybe there is this compensating factor on the other side. So yeah. Anyway.
So I'm going to collect questions, because we have to leave time for Rob Engle. So Thomas, maybe quick.
Yeah, my question would be related. How many people might be hit by such high temperatures in combination with high humidity, where it basically becomes lethal to be outside for longer time periods?
Thank you.
This has been discussed for part of India, but is it really such a big problem, or is it total exception?
Yeah. Alex? Unmute.
Yeah. So now I'm unmuted. So two questions. So one is on this, like, hitting the boundary. You could use value of life estimates to expand this value estimation. And then the other thing I had as a question, and I don't really know a good answer to it. Wages are exogenous in your framework, right? But if temperature affects productivity and affects capital stocks and so on, then wages are endogenous. And how would that affect your estimates?
Final question for Larry Kotlik. For Larry?
Yeah, I was just wondering if you were looking at the whole present value, the disk utility, or is it just initial generations? And also, have you actually looked at the productivity impact, since you seem to have the data as a separate? Can you tell us how big the social cost of carbon, and let's say 2%, is just because of the loss of productivity?
Okay, so can you try to answer reasonably compactly?
Yep. So Larry, on productivity, our results actually don't tell you anything about productivity that's inframarginal. It turns out that's really hard to get data on. You need basically like how many widgets are each worker putting together. We are on that present value. We're actually accounting for future generations as well, discounting it all back to the present. Alex, we are thinking about how you would think about endogenous capital stocks or long run growth affecting these projections. Right now, we're just using the standard SSP scenarios, which are a standard set of projections that sort of everyone is using. Thomas, on lethal temperatures, I would encourage you to look. We have an entire paper on mortality impacts where we do look at VSL. So it's an entire separate sector. And so I would encourage you to just look there. Francesco, I do So other people are doing important work on the leisure margin. I think that's important. And I think the beauty of the climate change problem is it's got so multifaceted. So what we're trying to do is develop frameworks where people can study different problems and put them all together. Nobody has to do the whole problem in one single paper. But I do agree with you that potentially informal work could have a larger impact. And I think that would be a great project if there's any graduate students attending this workshop to think about that impact. And so, yeah, I think those are all the questions. Thanks so much.
Thank you. So before we move on to the next paper, I think, Bob, you had, Rob, you had one more final question, and you not, or for Solomon. So maybe I'll answer that before you start your own lecture.
Okay, it's just a quick question that I mentioned before, which is, how do you treat migration in here? Migration is a type of adaptation, obviously, to temperature change, but there are a lot of costs of migration. Are those part of what you calculated? And what about the costs of moving capital, which I guess is a lot more expensive?
Those are great questions. Neither of those are parts of this analysis. They are parts of other analyses we're doing, and we would love to integrate them eventually, but both of those are held fixed.
Okay.
Thank you very much. It was an excellent presentation on extremely large and ambitious and impressive project. So we move on to the next speaker is Rob Engle. He's going to talk on the financial risk framework for climate change. And it's together with a number of co-authors, which will be clear on this first slide.
Okay, well, thank you very much. Let me put up the screen here. So I'm going to talk about work we've been doing at the Volatility and Risk Institute. And this is work that has a lot of co-authors, as you mentioned. And it's based on a paper that we published last year with Stefano, Giglio, Bryan Kelly, Heebum Lee, and Johannes Stroebel. And I'm going to show you actually things we've been doing subsequent to that paper, but we'll talk a little bit about that paper as well. So just for sort of background, we tend to think about, when we talk about climate risk, we tend to think about the physical risk as the key one, and that was what Solomon was focusing on: warmer temperatures, rising sea levels, droughts, floods, and storms. But also in finance, we've been talking a lot about transition risk, which is the risk associated with decarbonization of the economy. And this, of course, is based on some decision, whether government or private sector, to regulate price or somehow mitigate emissions. And these two risks often go in the same direction, but sometimes they go in the opposite direction. In fact, we should think about, as you did as we've been doing all day, that there are two actual sets of policies or behaviors that we ought to see. One is adaptation to the changes that are occurring, and the other is trying to mitigate them. So adaptation is making the best of it, and mitigation is trying to fix it. So we're going to come back to the end to see whether what we've been talking about is adaptation or mitigation. So I think there's a popular view now, which is that we should recognize that climate risk is investment risk. And so when we talk about the risks of climate change, these should be impacting the value of assets. And the question, of course, then is, how should investors choose optimal portfolios to account for these risks? And basically, we should think about climate risk as being a pervasive risk. It affects almost all assets. And excuse me. And so it's natural to try to make sure that as investors, we are aware of what these climate risks are are what they are. So basically, if assets are exposed to climate risk, then you would expect them to be less desirable, and that investors who are willing to to hold this risk should realize a risk premium and higher expected return on their assets. And so if climate risk is really impacts almost all assets, then if there is some way we can reduce the severity of climate change, then that ought to reduce the risk premium for all these assets and actually lead to a rise in market prices. So one of the first sort of implications of this is that good policy, or maybe good news that the environment is not as bad as we think, should lead to higher asset prices rather than lower asset prices. I think this is a natural result of the fact that what we're talking about is a negative externality. But when we talk about investment strategies, we're actually usually not talking about the market as a whole. We're talking about sort of portfolios within the market. And many investors are interested in impact investing. Many might be interested in charitable reasons for investing in assets which are good for the planet as a whole. I'm going to focus primarily on the third goal here, which is you might invest to hedge climate risk. That is, you might invest so that your portfolio has the property that if the climate turns out to be worse than the market expected it to be when you purchase your assets, that you would actually outperform the market. That is, you would smooth your consumption over states of nature from and therefore provide some reduced risk to your consumption. This has the benefit, of course, that it's going to lower the cost of capital for companies that are well prepared for climate change, and that's going to have social benefits as well. So what's the asset pricing implication for this? Well, if there's a risk premium to holding assets which are exposed to climate risk, then there is a negative risk premium to shorting those assets. And so we would expect that a portfolio which shorted the assets which were most exposed to climate change and went long assets which were most prepared for climate change would actually have a negative risk premium. And this is actually a topic we heard earlier today, and it's not surprising, because if this hedged portfolio is in fact risk reducing for the investor, it's like insurance. You might expect to pay a premium for climate insurance. And consequently, I think the first implication of asset pricing says that you would expect a negative alpha for hedged portfolios. But that's not the whole story, because the hedge is designed for climate outcomes which turn out to be worse than the market expected. So over time, if there is news that the climate is worse than the market expected, and of course, if the market doesn't expect much, then that may be most information about climate change. If there is news about the climate being worse than the market expected, then the assets that are long in your portfolio should go up in value, and the assets which are short in your portfolio should go down in value, and therefore there would be a net increase in value of your portfolio. And over time, as we watch the climate evolve, under these kinds of conditions, the news will accumulate positive alpha. When there is news, you'd expect the positive alpha, and that would overall offset this negative risk premium that we're talking about. So we can see there's a tension between whether we expect these climate hedge portfolios to underperform or outperform the market. And it depends on really whether we're getting new information about what the science and what the policy looks like. So it's a kind of an open question what we would expect these portfolios to look like. And so I'm going to show you, first of all, some stuff that we put on the VLab and we follow every day. We have a collection of just under 200 portfolios, which are publicly available and are designed for investors to hold that are interested in hedging climate change. These are basically ESG portfolios, but they're particularly focused on ESG funds which are climate oriented. And they come in different categories. There are sector funds, such as alternative energy funds. There are fossil fuel free funds, low carbon funds, low environmental risk, and some which have portfolios which say sustainability is the key thing that they're trying to do. Let me skip this slide. Let me just show you. So here is, for example, a little table. This is sorted by Sharpe ratio. And here we have over, this is a 1-year performance. So look at the return, the volatility, the Sharpe ratio, and you see Sharpe ratios are really extremely high for the first 10 of these funds. You know, we've got, as I say, almost 200 of them. So the top Sharpe ratios ought to be fairly high. We also have some correlations with news, and I'll come back to those in a minute. But here are the alphas that we're seeing and market betas. The alphas are very high. Well, what about overall on all these funds? If you look at the overall funds, you see the 1-year alpha on average is more than 3%. This is annualized return. 3-year, however, is negative. 5-year is negative. Exponentially weighted, it's actually about 0. And over the maximum period for each fund, it's negative. So they're positive now, but not necessarily in the past. And if you look at these different categories of funds, you see some of them are positive, some of them are negative. The biggest one are these sector funds, sustainable sector funds with an alpha, an average of 13%. If you look at benchmarks at the same time, you can see that the MSCI ACWI fund has a Sharpe ratio of about 1. The S&P has a Sharpe of 1. S&P, when it shorts the energy sector, the XLE, it's a half. And we have a fund here, which is the S&P, but it shorts 70% of a coal ETF and 30% of the XLE, and that has a higher Sharpe ratio. This is, again, these are all 1-year numbers. But if you look at the same sort of table a year ago, or actually this is last October of 19, you see that this table is full of negatives. Almost all of the funds had negative alphas here, except for some of these alternative energy funds in very short run. So I think the story is that, first of all, the reason these are all negative is that that's kind of our expectation if there's no news about the climate change. And the reason they look much more positive today is because there is news about climate change. And what is that news? Why are these climate funds doing well in our pandemic? If you look at the data for 2020, you'll see that they're doing very well. And I think the answer is we are seeing transition risk in process. We are watching it in real life. We've seen this incredible drop in the demand for fossil fuels through transportation being shut down, people working at home, people Zooming their conferences like we are today. You see the airlines, entertainment, retail, and tourism are all decimated sectors, but those are all sectors which rely a lot on transportation and communication. Even though some of these don't have particularly high ESG risk measures. And then who are the winners? The winners are the technology sectors. So in fact, you know, if you look at sectoral returns, and let's start last year, the return in 2020, the worst performing sector was XLE. I show that in red. And the best performing one is XLE. And notice the difference between those two sectors. I mean, that's just like a 70% return on a long short portfolio if you happen to be in technology and short energy. If you look at the highest volatility, which this is a volatility column, it's 60%, and it's also the energy sector. The same thing was true the year before in 19. The same thing was true, almost true in 18. And if you go back, you see XLE is red in most of these columns, not all of them. So what we're seeing is that even though this is very extreme in 2020, it was also true that the energy sector has been doing badly relatively over the last several years. Actually, in the beginning of 21, it's actually got the highest return. So, you know, we have yet to see what's going to happen as we go forward, but there seems to be an undoing of this result. So what's the conclusion from this? I think the conclusion from this is that we have seen this in 2020, a transition which is more rapid than anything climate policy could generate or is likely to generate. We have seen a reduction in fossil fuels that $100 a ton would never have produced. If we set a social cost of carbon at $100 a ton, that's $1 a gallon of gasoline, we would not have seen anything like the reduction in driving that we saw. So we have seen an extreme amount of transition risk during this pandemic. All right, so in asset pricing, when you see these alphas, the idea is that there's missing a factor. Well, the climate factor is what we're missing. So the question is, what is this climate factor? And can we figure out what it looks like? So the first approach to this, and I would guess maybe a common approach, is to try to fundamentally figure out which assets should be in this climate factor. And we have some data, but it's really not enough to give us a very good answer for what's in the climate sector. However, one of the things that is pretty natural to put in a climate factor would be the cost of carbon emissions. Carbon emissions are actually priced in some markets, and this market price is actually an indication of the role that public policy can make and what the cost of transitions really look like. So it turns out that now you can you can buy futures on these carbon emissions, and now there's an ETF called KRBN that we've been involved in starting, which is trading, and it's a global average price of carbon emissions futures. And it's designed so that when more and more markets come under cap and trade programs, that those will be included in this ETF. And so if we want a fundamentally based asset which does respond to the cost of carbon emissions, this is a beginning point for what it might look like. But second to that, we're left with using ESG data and trying to figure out what firms are going to be negatively impacted by transition risk and which ones are not, and how impacted would they be, and will they be able to pass on the cost of a carbon tax or whatnot. It's very hard to do that. So an alternative strategy, which is what I want to talk a little bit about today, is to say, well, maybe we can use this news idea to tell us whether we have a climate hedge portfolio. When there is news that the climate is worse, getting worse, which assets go up and which ones go down? Can we form a portfolio that has the property that it responds to the news in this way? It might have a negative alpha when there's no news, but when there's positive news, we would expect it to have positive alpha and positive returns. So we have several series. We're continuing to work on trying to get them better. None of these news series is as powerful as you'd like, but we have textual analysis of the New York Times. In the previous paper that I'm going to mention in a second, we use the Wall Street Journal. It seems to be similar. What we look at is both the count of the number of articles that are on subjects like climate change, and a measure of cosine similarity, which looks at how similar the word counts are in these articles with in climate news dictionaries. So I'm going to not really deal too much with this. The paper with Stefano, Bryan, Heebum, and Johannes builds a factor mimicking portfolio, which has as its goal being maximally correlated with the stocks, that a universe of stocks. And because that's of course got too many parameters in it, what we use are e-scores from Sustainalytics to form portfolios, and we compare those with other ways of forming portfolios with characteristics such as the carbon emissions and so forth. And this is what we report on there is the best of these portfolios. Here are the kinds of words that are used in this news series. This is a word cloud having to do with the frequency of different words that are mentioned in the climate dictionary, and then we look at how much they're mentioned in the articles. And I'm going to show you some results on this. One of the things that's, I think, important to remember is how we treat news in finance. We have lots of studies, quantitative studies, such as event studies, which look at news. And what we say is, well, if there's good news, then what we expect is to see the price go up. And we're interested whether it happens right away or might have leaked ahead of time or whatever. But when there is no news, we have no expectation about what the direction price should go. In other words, if there's news one day and no news the next day, we don't expect the price to go back down again. Each news series is a permanent news series. And the implication for that is that we should expect the news to have the level of the news to be important, not the change in news or not the innovation in news arrivals. And that's the way we're going to set this model up. So let's see if we can figure out how to do this factor mimicking portfolio. ESG vendors have lots of competition. There are lots of different measures of ESG. There are lots of funds who are desperate to have ESG and green items out there because the demand for these kinds of funds is very high. And so we're going to start with funds which all have an ESG type of credential and try to figure out from these funds what really is a climate factor and what does it look like. And so in work which is now going to be with Jean-Luc Denard and Bryan Kelly, we're looking at a problem of forming linear combinations of publicly available funds. These are going to be linear combinations which are long only because we think that all the funds either are irrelevant or should be in there with a positive weight, but that the weights may change over time, and they may change over time as the news happens, and they may change over time as just the environment and other kinds of costs and benefits seem to change. And we want to find this fund that has a linear combination which has the highest weight on climate news series. So the simplest way to think about this, it's easy to do. What we do is rolling regressions to get where we regress each fund's return on a bunch of factors and then the news. And we look at the beta on the news and then use that beta as an input to figuring out what the portfolio weight should be. If the beta is negative, we ignore this fund. If it's positive, we give it weight in the fund, and the higher the beta, the more weight we give. And actually what turns out to be a little better than that is to multiply the beta times the t-statistic, because that gives you say you give a higher weight if the beta is high, or if the t-statistic is high, or both. So we do this using, say, a 6-month history period. We form a portfolio and hold it for the next 21 days, and then we redo it. So it's a monthly portfolio, but it changes every month. And how do we know whether, so the 21 days of returns are all out of sample. So in fact, we have a whole out of sample performance of this factor mimicking portfolio, and we can ask whether out of sample is correlated with the news. And this is done by running the same regression, but using the factor mimicking portfolio to see whether it's still correlated with the beta when we are doing it all out of sample. So I'm going to show you some results for this, but I'm also going to show you a more systematic and attractive method for constructing this portfolio. That is, we've got returns, we've got factors, we have news, and this is the regression I just described, regressing returns on news, factors, getting a return. We do as a rolling regression so we get betas over time. Well, we want to form a portfolio which is a linear combination of these returns, and we like this linear combination to have the property that it has as low a variance as possible and as strong a signal with the past as possible. That is, we want the weights to be high on the beta, on this beta signal. Well, what's the beta signal? Well, it's the positive betas divided by the average of the positive betas is one signal, or the beta times the t-statistic. And so the relative weight we put on low variance versus high signal depends on the choice of lambda 1 and lambda 2. So for different values of the relative size of lambda 1 and lambda 2, you get a lot of different portfolios. And for one set of choices, you get the simple one that I just showed. For other ones, you get a variety of things like Fama Macbeth and so forth. Okay. In order to do this, we need a big covariance matrix. And this is, since we've got 179 funds, we need 179 by 179 covariance matrix. That's a little complicated, but there's a series of papers we've been doing looking at this. And here's sort of a picture of the results for either the cosine similarity or the count of articles. And This is the alpha of the portfolio. This is the beta on the climate news. These are the out of sample numbers. This is assuming that the covariance matrix is the identity, assuming that it's a static shrinkage, assuming it's a dynamic shrinkage, or that you don't give any weight to the minimum variance, in which case you're only going to pick the best fund. So you can see this is a pretty attractive column because it's the highest value for both the alpha and the beta in these stocks, and I'm going to show you results for this. So here, this kind of gives you the flavor for what's going on. If we calculate this factor mimicking portfolio, every observation is out of sample of this portfolio. We can regress it on cosine similarity, climate change cosine similarity. We can regress it on the climate change stranded asset portfolio that I mentioned, the market factor, HML, SMB, and the return on oil. This is the kind of regression we do. The key thing here is it correlated with the news? And the answer is, well, yes, out of sample, it is correlated with the news. It doesn't have a very big coefficient, 0.1, but it is significantly correlated with the news. So this is kind of the validation. If you look at this portfolio and you regress it, instead of regressing it on the news, you regress it on a constant, you get the alpha of this portfolio, and it turns out to be 7.6% a year. If the stranded asset portfolio is actually a little better, 8.8. So this is a portfolio that's designed to have high correlation with the news, but it also happens to have high alpha. And one of the things that we originally thought is that this should be interpreted as a physical risk portfolio. But in fact, I don't think we think it is a physical risk portfolio. A physical risk because we've taken out the stranded asset portfolio, so what's left over should be physical risk. But I think there are a lot of other aspects of climate risk that are incorporated in this portfolio, which are not physical risk. And in order to see what they are, let's take a look at what the biggest holdings are. What are the biggest holdings here? Well, here's the same China Environment Index, lithium and battery tech, global clean energy, solar ETF, global clean energy, lithium and batteries. We're seeing a lot of clean energy here. These are alternative energy sorts of funds primarily, and these are the weights that they take in the portfolio. This is at the end of the sample. This is at the end of February. The top 4 positions I just showed you. Here's what the betas look like over time for these 4 positions. And of course, I showed you the ones that were the top 4 at the end of the sample period. So it's not surprising that they're high, but you can see they've been rising sort of since the beginning of 2018. And they were high, some of them at other times, and low at other times. So that there seems to be a lot of time variation in which funds are really the most important ones to put in this portfolio. And there are several different explanations for why these would be changing. Among other things, the portfolios may be changing. Among other things, the environment may be changing. And so the proof of this is actually how it performs. So how did it perform last year? Well, last year, the big event was COVID, but it might not really be the biggest event that's been going on. If we look at the annualized investment in this climate portfolio, it has an alpha of 73% in 2020. That is, again, a piece of evidence that this was really a time of big transition risk in the global economy. The stranded asset portfolio also did well, but not as well as this factor mimicking portfolio. So what are we going to do with this portfolio now that we have it? What's it good for? Well, one thing is we could invest in this directly because these are all publicly available funds with positive weights. We don't have to do any shorts. We can just hold this portfolio. We could also invest in portfolios that have a high beta on this portfolio, because then they would presumably inherit this property. Another thing we could do would be to measure the risk and return of a hedge portfolio by estimating this with the volatility, and we're going to do that. And I'm also going to show you how we use this to do stress testing of the banks. I mean, this is just very briefly. So what's the volatility of this factor mimicking portfolio? Well, if you look at a asymmetric Garch model, one of the things you see is the asymmetry comes in with a negative sign, which is exactly what you might expect for a hedge portfolio. Typically, a risk-based portfolio has positive asymmetry, but a hedge portfolio should have negative asymmetry. And that's what it has. And here's what the volatility of this thing looks like over time. And you can see this is the volatility essentially of the daily change of this portfolio. So it's a response to new information is what we're seeing here. And it's got some peaks in it, but basically it's really quite high over the last year or two. I'm not going to show you, but you can regress all the stock returns on this portfolio and see which funds have the highest betas on this portfolio. If we stress test banks, we can do this the same way we've been doing with S-risk. We calculate the impact of a change in this factor mimicking portfolio on the stock market return of a bank. Well, why would it affect the bank? Well, if the bank is holding assets which are sensitive to climate change, then if the factor mimicking portfolio suggests that climate is getting worse, then the assets of this bank are likely to go down and the bank might need new capital. So we calculate in the same way we do with S-risk, we calculate the dynamic climate beta and use that to figure out whether the bank would be undercapitalized if this factor mimicking portfolio or the stranded asset portfolio, which in fact is the one I'm going to show you, if that portfolio goes down dramatically, how undercapitalized will the banks be? So here's a picture of US banks, and this is the beta we're seeing. So here's beta equal to 0, and when beta is positive, it means that the bank's stock returns are sensitive to the climate risk measure. And you can see that the betas have been rising, particularly at the end of the sample period, but also in this period they were high. But they're not uniformly high, but they are going up now. If you look at the UK, you can see that betas are almost all positive, and it may be that either that the banks are holding more climate sensitive material or the market is more aware of what climate sensitive loans look like in the UK. So what this research is really trying to do, it seems to me, is help asset prices reflect the actual risks that are going on in climate change, to better risk evaluation. And as a consequence, it seems to me what we're really talking about is adaptation, that the financial sector needs to figure out how to be more adaptive to climate risks. But adaptation is not the whole problem. it's really mitigation that we want ultimately to be a part of the solution, not just adaptation. And I don't think that this optimal portfolio construction or risk pricing will do the job in solving the externality problem that really is fundamental to climate change. And so my view is that these are important steps toward getting the market to respond to climate risks, but this does not mean that we don't still have to put a price on carbon or regulate it or somehow push the envelope on mitigation if we want to have some kind of optimal policy. So, you know, this is, I think, a step toward getting this done, but I don't think this is the end. The private sector capital allocation is not going to solve the problem. It's just going to mitigate it. It's just going to reduce it. So I think we're making progress in measuring and hedging climate risk. We're going to force the repricing of assets to reflect this, but is this enough? I don't think so. And so here are my three of my grandsons. I now have two more. Looking out over this calm lake that I've shown you earlier, wondering whether the world that they're going to inherit is going to be livable. But if we can tell them that we've solved not only the adaptation, but also the mitigation problem, they'll be a lot happier. Okay, so I'm going to stop here. Thank you.
Wonderful. Thank you very, very, very much, Rob. It was very good indeed. So the floor is open for questions. Yes, do a bit of doing this again for everybody.
Is there any way this work can help inform the optimal carbon tax?
I'd like to think there is, but I don't quite see what it is, because you're going to have to price the externalities and they're not priced. I mean, I have some ideas as to how we could get prices, but I don't think it comes out of this factor mimicking portfolio, which is too bad, I think. But the idea that if you put in place a policy that's going to reduce the risk, you should see the market respond to it. I don't know whether you can tease out of that what the optimal policy is. I think it's hard to do.
Can I ask a question, Rob? So you talk a lot about transition risk. So then you typically think, what happens if society or politicians start stepping up climate policy? But this equivalently, there's a risk maybe that there's a sudden breakthrough in renewable technology, which makes a lot of these fossil fuel firms kind of maybe obsolete or whatever. There's a risk there as well. Right. That's not really captured in your Google searches and everything, is it?
Well, so you're sort of asking, what does our news really measure? I mean, it measures a lot of information about that there are news articles about climate change, but it doesn't really say whether they're transition risk measures or whether they're physical risk measures. And maybe even more importantly, from what you said, it doesn't say for sure whether they're good news or bad news. Now, my feeling is that the news stories about severe weather, news stories about hurricanes and wildfires and all that sort of thing, that's all bad news about the climate, that the climate's getting worse. And this is all information that I think would be used by investors to say, you know, I really think I better do something. I better put something together for my hedge portfolio. But I don't think it's so obvious about the transition risk. In other words, news that we're dropping out of the Paris Accord. Well, there was a lot of news about that and a lot of discussion about it, but that is not going to be clearly news that the climate's getting, maybe it is news that the climate's getting worse, but it's not necessarily going to move markets in the same direction. So I think, so we've spent a lot of time trying to get separate news stories for transition and physical risk. But so far, we're not able to get really good estimates of the physical risk measure through financial markets by correlating with kind of news that has to do with the climate. And I don't really know whether the physical risk is actually being priced in the market. If you ask yourself, I want to divest my portfolio of companies that are exposed to physical risk, it's not that easy to figure out what that means.
Okay, Eugenie.
I had a related question, but more practically. I was thinking about the use of sentiment dictionary, and I was wondering whether you have thought of combining this sort of text analysis methods together with your climate vocabulary dictionary, just so that you would be able to have a measure of positive versus negative types of news. So there are a lot of dictionaries out there of positive and negative terms that you could combine with your climate dictionaries to help maybe disentangle what is good. Of course, it's not about disentangling the transition versus geophysical risks, but these two dimensions are embedded in each other.
Right. So I think it's the regulatory thing where it might really be important whether you're regulating or deregulating. And I'm not quite sure whether sentiment makes it clear. It depends on whether it's written by the fossil fuel energy or the Environmental Defense Fund, whether you get a negative sentiment from it. But it clearly, if we're deregulating, then that's going to be positive news for fossil fuel energy. And if we're re-regulating, it's going to be negative news for them. So we would like very much to be able to do that. We have used sentiment data to modify our news series. And in fact, one of the series we used in the RFS paper combined sentiment with climate news. It doesn't really work any better or any worse than the other news series we had. And you know, I think one of the things that we should notice is that in finance, we're used to looking at news where the market is very responsive to the news. When we look at Fed announcements or earnings announcements, we're looking at things where the market moves within seconds of the announcement, and people are queued up to do this. When you think about climate news, it doesn't work like that. I mean, the market does not see the immediate payoff from being the first person to read these news stories. And so I think we're talking about a much more slow moving kind of news series. And it's going to be more aggregated over time. And at least for the moment, I don't see that we can apply the kinds of techniques that have worked well in looking at earnings announcements and macro announcements to the climate business, because it just isn't that responsive. Now, maybe as we go further and as there's policy really lined up, ready to go, people will say, okay, no, it really, whatever, whenever John Kerry opens his mouth, we're going to pay attention, because we're going to, you know, sell our coal refinery, I mean, our coal power plant. We're going to be the first one to divest of it. So maybe we might come to that, but we're not there yet.